I'm Becky O'Mara from the AFC, and I just wanted to quickly say thank you so much to Winston and Strawn, who is the sponsor for this webinar today. It's very topical, and I'm sure everyone's very interested to hear all the thoughts of all the experts on this call. So Juan, I'll hand it over to you. Really appreciate all of your time and effort on this. So thank you.
Thank you, Becky. I appreciate it. My name is Juan Azel. I'm a financial services partner here at Winston & Strawn. We are joined here by an amazing panel to discuss really a very topical topic, right, if you will. And I'm going to be sharing my screen now and showing you, some of a few slides on here about this particular topic. But our topic today, as you can see, is overdraft junk and late, the many fees of the CFPB and the role of Fintech in changing the industry. My panel consists today of my colleague, Jennifer Olivestone, who will also be moderating a question and answer session with the other panelists, who are Chris Adams, the chairman of Coastal Community Bank, Armen Meyer, senior policy advisor at the American Fintech Counsel, and Bradley Schecter, the chief compliance officer at Avant. So quite a panel of experts on this topic. We're going to start with a bit of laying the environment, the groundwork for what we're going to be discussing in just a few minutes, but we thought it would be good to really discuss what junk fees really are from the perspective of the CFPB, because there's a little bit of I would say, confusion as to what a junk fee is and what type of product-based fee does it relate to. But I think we should start with of course, the CFPB supervisory highlights, right, as at the end of last year. And if you look at that first paragraph, there's some things that should stand out to us as we look at what is a junk fee, right? We're really looking at unnecessary charges, right, that offer little to no value to the customer, right, inflating their costs. They are considered to be unavoidable or surprise charges. And finally, they have the tendency to be hidden, disclosed later once the consumer has progressed in a purchasing process, or not at all, right? These are really fees that the CFPB finds have absolutely no value other than really to for revenue for the particular financial institution. But that may be oversimplifying a little bit, and we're gonna go through this process of looking at each of these products in a second. But really the products can be categorized into a few categories. Those that have been interpreted in many ways to constitute junk fees, and that's non-sufficient funds and overdrafts. We'll take those together. Then we'll talk a little bit about late fees, and then miscellaneous fees, right, such as fees for basic customer service. This is the broad category of products that we have seen action by the CFPB, whether that's an advisory opinion, a notice of proposed rulemaking, or something else, right, or enforcement, obviously. So let's start with NSF and overdraft fees, and let's see where we are on this in this particular segment, right? Just by virtue of a quick summary, the NSF fee, I think we all know what those are. Those are charges that are imposed by a financial institution when you are declining a payment, right, from a customer account, right, whether because the customer account lacks funds. Or as opposed to an overdraft is really where you give effect to the payment, but you charge a transaction when there's an overdraft on the particular account because there was insufficient funds to begin with. So somewhat related, but as we will see, not exactly the same in terms of CFPB action. We have seen increased usage of these fees in the areas of debit card, authorized positive, settled negative transactions, and then the back-end practices of banks. What has the CFPB said recently about this? What really is a concern about this, right? And this is all from their observations. As you can see, they've estimated that a quarter of customers reside in a household that have been charged an overdraft or an NSF fee in the prior year, right? That's 23 million households paying overdraft fees in any given year. And here is the crux, right? Why is it that the CFPB is most concerned about this? It's because the consumers who are typically charged these fees are consumers that have lower average credit scores, subprime credit, or more likely to have that, and no available credit on a credit card, or delinquent debt. So this, in the CFPB's role, they are looking out to ensure that customers that are disadvantaged from the perspective of credit or ability to access credit or low income are not being charged fees that they cannot afford, right? So they also observed that financial institutions, banks make a lot of money from NSF fees and overdraft fees, right? They estimate that approximately 19%, right, of the revenue of overdraft NSF fees, it comes from the NSF revenue, right? And so we have institutions making a significant amount of profit from overdraft loans in generating billions of dollars annually. Okay, so what have they done about these two particular fees that we're talking about here, right? The first thing they've done is really just come out in these circulars and said UDAP violations, that these fees could constitute UDAP violations. So as we know, the CFPB has the ability under Dodd-Frank, if you have a bank over $10 billion in assets, they will supervise that bank for consumer protection, consumer compliance with consumer protection laws or regulations, and that includes UDAP with an A, adding the abusive prong to the FTC UDAP section 5, right? Abusive, deceptive, unfair, and abusive practices. So they're able to really look at this and say this constitutes this in these instances, right? So there's no notice of proposed rulemaking here. This is just, we believe, we're a regulator, we're interpreting this particular statute to apply to this. So what type of fees have they looked at this? I'm not going to go through this whole list, but as you can see, we're looking at NSF fees for the same transactions when there's representments, right, of a particular fund. This happens a lot in the fintech industry, as you know. The merchant represents the same transaction, so there's kind of like a churning of NSF fees by the bank. They've said this is likely to constitute a UDAP violation, right? Same thing for return deposit items, surprise depositor fees, right? When a check bounces, irrespective of the particular transaction or behavioral activity of an account, it's just an automatic, check bounces, regardless of if it had been the first check that bounced in 10 years, it still does the, it imposes the fees, right? And I think that's critical for our membership here is the part at the bottom that examiners have found that the bank's use of service providers can contribute to illegal fees. They're talking about TPRM here, right? They're talking about third-party risk management. And they're saying the use of third-party service providers, and I think that's also a bit of a dig to fintechs, can contribute to illegal fees. How that happens, why is that because the bank side has ineffective CMS, or is that because the fintech itself doesn't have a proper version of a CMS to align with the banks and ensure this is happening? We don't really know, but what they've said is that at least the examiners on the ground have found that is a contributing factor, right? So the CFPB has been busy, right, with supervisory and enforcement efforts, and they are happy with their results, I think, in terms of the NSF fees, at least with respect to the bounce checks. Why? Because they've noted that nearly 2/3 of banks which they regulate, right, those over or supervise, those are for consumer compliance, those over 10 billion have eliminated those fees. It's a lot of banks. And they've also noticed that 90% of the fee revenue among banks that they regulate has been eliminated. So pretty much banks have if you take these numbers, banks have pretty much done away with NSF fees altogether, right? And so what's their next focus? Overdraft, right? At least within these two fees, right? And so we're looking at a notice of proposed rulemaking, right? Surprise, that just happened very recently, I think a week ago or so, right? We may have seen this, and what this is being aimed at is reducing excessive overdraft fees charged by banks. And the way they're looking at this, right, is an overdraft at the end of the day is an extension of credit. So we've got TILA, right, possibly out there, and they have used TILA to say, or again, this is a proposed rule. They're looking out for comment. But we know that TILA has for many years accepted or exempted overdrafts from the definition, right, of credit, right, open-ended or closed-end credit. This does away with that a little bit, right, this proposed rule, and really treats it in many ways like an overdraft, like an extension of credit subject to TILA in certain circumstances, right? And the point here is that they're concerned that these overdraft fees are very high, as you can see there, and that they do not consumers generally not receive any loan-related disclosures for their overdraft services, right? We know TILA is it's a disclosure statute, right? In many ways, obviously, as well as a finance charge definition, but it is at the end of the day a very strong disclosure statute to be able to give consumers clear information as to how much the cost of credit. So they feel that that's not happening with overdrafts, right? So the proposed rule, right, would apply only to insured depository institutions, obviously, that they regulate. And again, we're not going to go through this. We're probably, our firm will probably issue, we're working on an alert for this. So look out for that. But honestly, I think what the most important thing that you need to understand here, I think, is that when they talk about overdrafts as a courtesy service, leaving aside the line of credit, at the end of the day is going to be subject to TILA almost assuredly. And we know that it's ECOA as well in some instances. But when we were looking at it as a courtesy service, they simply do not want banks to charge more money than their costs, right? If they can be directly traceable to the provision of the overdraft. And if that's too hard to do, the CFPB is proposing to come out and tell you how much is too much, right? So they're really getting into the revenue of the individual bank in terms of the overdraft and trying to really regulate it that way. They're not as shy, obviously, we know about consumer protection, but this is a pretty big, I think, move into this area, right? And ultimately, at the end of the day, if you are making profit off your overdraft loans, then guess what? It's going to require compliance with TILA, which in many ways, I'm sure many bankers here may tell me, that's essentially going to kill the overdraft. They'll probably stop doing it just because the cost of compliance with TILA and overdraft is probably so big that it may be something. And maybe that's the purpose of it, right? To reduce the amount of it as well. So just going to say this quickly because I want to, obviously, Jen and I obviously want to get to the panel discussion. But the comment period on this is going to end in April 1st, 2024. It would be adopted. If it would be adopted, it would go into effect in October 1st of 2025. So there's a little bit of time for this. But I think this is something that those that are interested that consider having either joining an industry group and having a proposed setting up a proposed news, right? And then we have a breaking news story, right? If you've been paying attention this very morning, just to show you how junk fees are at the top of the line or the top of maybe the president's desk, certainly Director Chopra's desk. There has been a proposed rule to stop new junk fees on bank accounts. We told you that NSF fees are pretty much been eliminated really on bounced checks, but now they're looking at transactions at the swipe, tap, or click, right? Components, right? Those that are debit card purchases, ATM withdrawals, declined peer-to-peer payment companies. And I think that we should all read this very telling quote from Director Chopra, where he's basically is slamming the industry for concocting, as he calls it, new junk fees and that don't deliver anything, right? And he says, and we'll talk a little bit about this later, that banks should be competing to provide better products and services, not innovating or imposing extra fees for no value. And if you want to know what the trend is going to be this year going forward, read the last sentence. The CFPB is going to continue to rid the market of junk fees today and prevent new junk fees from emerging in the future. So not only the ones that are here today, that they feel, if the industry continues to innovate, as he calls it, innovating junk fees, right? And he says you should be innovating, more better products and services. We're going to continue to prevent it from happening through regulate, and then you can believe that's regulation, enforcement, and everything else. So we're going to talk now. I'm going to turn it over now to Jen to talk a little bit about late fees and miscellaneous fees. Jen.
Okay, thanks, Juan. So moving on to the latest to late fees. For some context behind this issue, aside from what's posted on the slide, the CFPB issued a report in March 2022 that compiled a number of findings on late fees, credit card late fees. The two takeaways from that report were, one, the market reliance on late fees. Included within that report, they stated that late fees represented 99% of penalty fee volume on credit cards. And two, the disproportionate effect that the late fees had on the more economically vulnerable consumers. So those with subprime or deep subprime credit scores. Other observations over the years are the ones that we listed here and, are consistent with the findings in that report that, the credit card late fees are being relied on in the industry as a source of revenue. They're hitting consumers with as much as $12 billion a year in late fees, and that's in addition to other consequences that consumers face by late payments. And that late fees have even been as high as $41 or even 100% of the missed payment. So all of that served as impetus for the proposed rule that was released last year, pursuant to which the CFPB proposed a rule to amend Reg Z to ensure that late fees are reasonable and proportional to the late payment requirement under TILA. The way that it works under the current regulation is that with respect to any credit card penalty, an issuer can issue a penalty that exceeds the credit limit or return payments, or cannot unless they've determined that the dollar amount of the fee represents a reasonable proportion of the total cost incurred by the issuer or complies with the safe harbor provisions. So the safe harbor is within that section 1026.52B, where it sets forth certain amounts, specific amounts for penalties generally, and for subsequent violations of that same type that occur in the same billing cycle or over the next 6 billing cycles. So it also provides for modifications due to, to reflect inflation, the changes in the consumer price index. When it was initially set up, the safe harbor was $25 generally for penalty fees and $35 for each subsequent violation of the same type, that occurs during the same billing cycle or in one of the next 6 billing cycles. It currently is at $30 for the first and $41 for subsequent. The proposal would actually lower what they refer to as this immunity provision to $8 for late fees to $8 for a missed payment and end the automatic adjustment for annual inflation. It would also ban late fees that are above 25% of the consumer's required payment. So the practice that, they find that issuers can issue late fees that are 100%, they would no longer be allowed to do. The deadline for the comments to the proposed rule was the later of April 3rd, 2023, or 30 days after. It appeared that had been extended because comments were received as late as November of last year. And, it was interesting. There were over 57,000 comments that were received as a result of this proposed rule. Many of them, were from individual consumers who were in support of it. But, there were really interesting points that were made in some of these comments. I, of course, did not read all 57,000, but, some said that this would end up hurting consumers and issuers because the issuers might need to make up for this revenue source in other ways, increase the cost of credit, or and it would hurt issuers that would have to manage their credit portfolios and figure out ways to adjust the loss. In any event, it appears, based on the report that the CFPB issued within the last few weeks, that it's up and coming, that it's going to be issued within, soon as a final rule. And so it'll be interesting to see, what the final rule looks like. So moving on to the next category, they've also looked at miscellaneous junk fees. We've highlighted some of those. Some are fees that they've seen for fake paper statements, where they didn't print paper statements but charged for them. Some are fees for worthless add-on products like guaranteed asset protection insurance. Some were fees in connection with international money remittance transfers, where they failed to disclose fees that were taken out of the funds consumer sent, or charge fees when they failed to, send the funds on time. Other things, we didn't include everything, but other things are things like, the pay-to-pay advisory opinion that they released, where debt collectors can't charge fees based on the method of payment of the consumers unless it's explicitly permitted by law. So now moving on to the advisory opinion that was released in October of last year, they released this opinion that was tied to Section 1034C of the Consumer Financial Protection Act, which requires large financial institutions, so those of an asset side of more than $10 billion, as well as their affiliates, to comply with consumer requests for information concerning their accounts. what they were finding. And so this kind of ties in the concept of junk fees and customer service, because it discusses other things beyond just the fees. But, it specifically said that, large institutions should not be charging fees for paper statements, for questions related to loan balances, anything like that, but subject to certain exceptions. So what's interesting about this advisory opinion is that, usually the CFPB issues advisory opinions in response to questions. It's not clear, what question was asked here. There is no, they cite to the statute, but there's no implementing regulation. So, but nonetheless, even though it's an advisory opinion, it appears that they're really treating this as having the force of law. And even though it's targeted toward large financial institutions, smaller institutions might want to consider also, looking at what the CFPB has done and what they're charging for. So I think that gets us, I think we're maybe one slide past here. Yeah, I think we're up to, kind of looking ahead or.
Okay, great, Jen. So let's look at some other federal action that is taking place in this space. It's not just the CFPB. We have seen that the OCC and the FDIC, obviously for those banks, it is very important for those national and non-member banks that have less than $10 billion in total assets, that the assessment of NSF fees or overdraft fees can constitute unfair deceptive acts or practices, right? Without BA. So we're talking Section 5 of the FTC. So this is not just a CFPB focusing on these NSF fees or overdraft fees. We'll see to what extent the regulators, the prudential regulators, focus on the other areas of the fees that we've been talking about today. But so far, we've seen a lot of activity on these NSF fees or overdraft fees. And then not to be left behind, the FTC has proposed a rule to prohibit junk fees. Yeah, right. We may have seen, some of these may have seen this last year. They're looking at same kind of things, right? Hidden bogus fees can harm customers, and then really would ban businesses from running up bills with hidden and bogus fees, and to ensure consumers know exactly how much they are paying for and receiving in return. This comment deadline passed on January 8th, 2024. And Director Chopra, I think this indicates that this is a concerted approach by the administration, right? And I think we have seen the agencies really align very well on this. And so Director Chopra talked about the FTC rule and said that if finalizes this rule, the SCB is going to enforce this rule against violators in the finance industry and ensure that these firms play fairly. So this is how this FTC rule is also going to go directly and to the obviously those financial institutions under CFPB supervision, right? So we're coming to the end of this presentation before we come to the panel. So, but I want to talk about the big picture for a moment, right? We know that junk fees is connected to the White House initiative on open banking. When you look at the CFPB's guidance, the advisory opinions, the observations, it's really focused on competition among financial institutions with respect to the elimination of these fees, right? And it all appears to support and accelerate the White House initiative of open banking. In a sense, what the White House, I think, what this administration is doing is taking a bifurcated approach. From open banking, it's making it easier, obviously, for institution or for individuals to divorce, right, or walk away from their financial institutions by making it easier to transfer their information to another institution. So therefore, putting market pressure, right, on the institutions with respect to their fees. But at the same time, right, they have the CFPB specifically, enforcing, issuing, as we've seen today, guidance, notice of proposed rulemaking, and really being very, doing that regulatory type of enforcement approach on the actual fees themselves, while at the same time, you have an open banking initiative to make the market perhaps police itself in a way. And we're going to talk a little bit about that to the panel to see what they think about that in a few minutes. So looking ahead to 2024 very quickly, I think every financial institution needs to really carefully review any fees and charges imposed not only by itself, but by its partners, right, on consumers. What type of fee is it, right? Remember what we were talking about at the beginning, right? Is it an unnecessary fee, right? Is it perhaps a fee that has little to no value, right? Is it unavoidable or surprise fee, right? Is there this proper disclosure, right, on the second one, right? Is it hidden, right? Or is it disclosed only at the end of a process? Fees are being looked at and charges are being looked at very carefully. It behooves every institution and make sure that the Fintech partners are doing the same thing. The disclosure aspect is a UDAP concern, right? As we all know, how are they disclosed to consumers? You don't have to wait for notice of proposed rulemaking for this. The regulators are already looking at this from the perspective of an unfair, deceptive, or abusive trade practices. And not to be outdone, the states are getting into the game as well, right? We have seen California enact a law generally banning junk fees that is to take effect this year, right? So there's also a state perhaps initiative here. And at the end of the day, what is the impact of these proposed rules? So as I mentioned, I encourage the membership to get together with industry groups and really think about proposing comments on this. As Jen mentioned, 57,000 comments in the credit card space, right? If this could be something that could affect the financial institutions here, I mean, it definitely is worthwhile, commenting. It does make a difference. I mean, Jen and I spent a good amount of time across river, and we commented a lot on a lot of these institutions or these notice of proposed rulemakings, and I think it made a difference at the end of the day. So last thing I'll say here, and looking ahead, you saw Director Chopra's comment just today. Supervision, enforcement, and rulemaking is going to increase. There's no doubt about it. They're focused on it. So we got to make sure that we have a proper compliance management system, third-party risk management to cover that as well. Okay. So at this point, I'm going to stop sharing my screen and I'm going to turn it over to Jen so that we can have some questions from our very illustrious panel. Jen?
Great. So I also just want to mention there is a Q&A box. We're going to try and get to it. There's a lot to talk about with this topic. We could probably spend hours talking about every single one of these fees. But, please send in your questions, and, if we can't get to it, we will try to. You are welcome to contact us after this panel as well. So I guess maybe turning to the proposed overdraft rule, which is the most recent aside from the proposed rule that was issued today. So I guess just the question for the panel is, what do you think the impact of this will be on the industry, and how will banks and their partner fintechs plan for this? And, what changes need to be made in connection with maybe their compliance management systems to the extent that it's finalized in order to comply with this rule? At least as it's proposed now. I mean, we don't know what the final rule would look like.
Jay, I'm happy to go first, unless Brad or Chris want to. But okay. But I do think we can't skip over this morning's rule. We should definitely get in the overdraft. Can I ignore your question for just 1 second?
Yeah, sure.
and start with what happened this morning? Because I think it actually, in some respects, fundamentally changes how the CFPB has opposed junk fees. Not because a bunch of fees that no one was charging, that Rohit Chopra himself said was a preemptive measure. As Juan laid out, we're talking the fees that were addressed, the substance of this morning's proposal isn't the critical thing, in my opinion. What's really critical is the CFPB has really changed tact in how it approaches junk fees. And so when I was thinking about this panel yesterday, I actually would have made different comments had it not been for what happened this morning on how the CFPB is going at this. So this is the first time we're seeing the CFPB say, you remember that abusive thing that no one likes? And that was like this add-on on Dodd-Frank, and that we issued some guidance on last year that no one liked, and that the Kraninger and Trump administration ignored and tried to narrow. We're bringing it back. And for the first time, we're making a rulemaking under it. And essentially for the first time, we're not going to rely on the unfairness or the deceptive clause in our UDAP rulemaking. We're going to go only abusive. This is all we're going to talk about. And they've done a UDAP rulemaking before, but they've never gone all around abusive. This would be an early use of UDAP at the CFPB for rulemaking, but then an all-in play on abusive, which I think helps explain why the rulemaking doesn't do a whole lot. I mean, I don't know how many banks in this call, probably not many. When I was at Lending Club, we didn't charge the fees that this rule is going to ban outright. And I think the trend over years has been to not charge the fees. And even in the smallish range of NSF fees that are being charged, this rule is only a subset of those fees, namely debit card and ATM, maybe some others, but right at the point of transaction, it's ignoring ACH, it's ignoring bounce checks. So it's not even getting all of the NSF fees. So why be so small unless the action really isn't in the substance, but it's actually in reviving abusive, which we haven't seen a lot from a long time. So what is that? So why does that matter? It matters because abusive and UDAP are obviously the most powerful source of rulemaking authority. They're also the most powerful sources of enforcement authority. It also matters because it's a way to be a little bit like the FTC, frankly. The FTC, you mentioned it in your presentation, Juan and Jen, thank you, issued its proposed rulemaking. And they were able to go at junk fees way differently than the CFPB traditionally has. The CFPB, to your presentation, has gone at like this fee and that fee and that fee. Now, the FTC kind of did it really differently. The FTC said, you know what? All these fees, we want you, the industry, including non-banks and financial services. And by the way, banks, Trope doesn't apply this to you anyway through the CFPB. We want you guys to disclose everything really clearly, really broad. We don't care what kind of fee it is. It better be clear. The bottom line cost better be an all-in number, not some weird separate add-ons. And any surcharge you have, you better clearly say what those things are, and they better not be redundant. So the FTC kind of had the ability to do this kind of big thing the CFPB has not been able to do by a rulemaking. And so I think what we're seeing here is the CFPB saying, hey, we want to some more action. We want to revive the abusive standard. We want to revive UDAP as a tool of rulemaking authority. And that's why they picked a really narrow thing to do this morning. I'm going to stop there and let my colleagues come in and overdraft it or NSF if they want. And then I'll have more to say on overdraft. I thought that it was important to kind of address what we saw this morning.
I mean, we could certainly continue with that if you think, you know, to your point, like, what do you think, how do you think banks are going to react to this, or fintechs? And it does seem like the rule was proposed, you know, they say as technology changes, additional fees are added. So it does seem like it's trying to get to that real-time payments, you know, faster payments, you know, kind of, yeah. So I don't know. How do you think banks are going to address it?
I'm Brad or Chris. I'm gonna let you guys jump in. I feel like I'm monopolizing.
You go ahead, Brad. Yeah.
Go ahead, Chris. From the banking standpoint, go ahead. I mean, I think in the short term, I mean, the momentum's there, right? I think your points that you're making in terms of what today means is really good. But you know what it changes, I think the need for really current communication between fintechs and the banking partners to make sure that we're sharing information, we're sharing what we know, we're sharing our perspective, thinking about what comes next before regulators come in and ask the next set of questions, and whether that's CFPB on the fintech side or whether it's our regulator coming into the bank to ask questions too. So I think the momentum is there in terms of what's happening on the fee side of things, but it really is going to take a ton of communication between banks and the partners to make sure that we're staying ahead of it and ready to answer the questions that are coming down the pipe. You know, the only thing I'll add is, and I'll tell you kind of what I took away from it for my organization. You know, my organization does not have a deposit product, right? So overdraft fees, not really applicable. But what I took away was there was a line in the press release, and I don't have it up in front of me, but where Chopra basically talked about, you know, that this sort of immediacy of a reject has no cost associated with it. And to me, what that said to me was, if you're going to charge a fee, you better be able to tie it back to the actual cost to your institution. You know, so while
NSF fees are probably still gonna be allowable. I think what you're talking then about the rate of that is okay, what do you get charged by, what is your actual cost as an institution when a consumer has a check bounce, when there's an NSF, and how are you quantifying that? It's almost like we'll jump ahead, I'm sure we'll get to the late fee rule, but the late fee rule has the safe harbor, and then you can obviously go outside of the safe harbor if you're able to demonstrate the costs. And I just see more of, you better be able to demonstrate the costs and justify the cost of these fees that you're going to charge.
So Brad, I agree on the overdraft rule. I think it's different from the NSF rule, right? Because one, it's not an outright ban, as you're saying. It's like the card rule. It's basically saying justify the cost. It's also like the card rule in that it says, or we're going to rely on TILA. So kind of the old way. We're not going to use expansive authority. We're going to use what we've been doing, our bread and butter of TILA. And then it's kind of more narrow in terms of who it applies to. It only applies to banks above 10 million, above 10 billion. But it's a bit of it's also like the card rule. Well, in that, it provides all these choices, supposedly. And if you read the overdraft rule, it makes it sound like there are all these choices of what this proposed rulemaking is asking for an input on. We have all these questions. But at the end of the day, let's see, the first question is like, let's get feedback on, can you guys reasonably, as a bank or a financial institution, can you reasonably defend your cost? And I don't see many banks pick that option. I don't see many banks being like, okay, I'm going to go through the whole process of defending my costs. Not just because, as Rohit Chopra said, I don't know, overdraft fee, the APR is going to be, not even 3 digits, not even 4 digits, easily 5 digits in some cases, right? So it's not realistic. And two, how do you provide an APR at the point of sale when it's an overdraft product? It kind of I wouldn't even know logistically how that's even possible. Maybe in the 22nd century, but I just don't see it even happening. So option one of the proposed rule kind of makes not a whole lot of sense to me. The second one, I'm just looking at the rule real fast here, is you disclose the APR, provide your fees, or just recover your costs. So both those are kind of hard to do. Or take a fee cap. Get a safe harbor, get around this whole problem, and we'll give you $3, $6, $7, or $14 as options. So when the numbers range that much, I think we know we're talking about $6 or $7. Call me crazy. I doubt they're going to go 3 and 14's out there. They got 2 numbers in the middle. So what we're really looking at is a rule that basically says, hey, we're capping overdraft fees at $6 or $7. We're not going to call it a cap. We're going to pretend like you have all these 2 other options, like providing a TILA disclosure at the point of sale or justifying the cost. But really, this is a cap. To Brad's point, see the credit card late fee rule, which is essentially going to end up being a cap for banks that don't want to have justify their costs. But by the way, I think everyone on this call and the American Fintech Council get some credit here. In a way, Rohit Chopra is a little late to the game. A lot of fintech banks have already been lowering overdraft fees. You saw Chime was on the board of the AFC. You saw Varo used to be in the AFC. Lending Club, when I was there, reduced those fees eliminated those fees as soon as you bought a bank. So this is a trend anyway among fintechs. I can see why the CFPB is doing it, but it's not like industry, especially our industry, hasn't been leading the way here.
Armen, one question, because I want to comment, because there's a good question here on this that I think we can approach. I think the question is one difference between the overdraft proposal and the NSF proposal, that the latter doesn't require notice of proposed rulemaking. And I'll answer that for a minute. And that's right. On the NSF proposal, or the NSF really decision, because that's what it was, it really is under the UDAP prong, right? Because as we talked about earlier, we saw NSF fees for the same transaction, the representments. So the CFPB does not need authority to look at something and view it as abusive or unfair, deceptive, or abusive, right? Obviously, it needs to have a standing to be able to do that or get challenged on that. But that's how they're looking at those NSF fees. And I think Armen, you said it's not every NSF fee, but it's really those that it's a pretty large category, so large that a lot of banks said we're just not even going to charge it anymore. in terms of overdraft, a little bit different, right? The reason it's notice of proposed rulemaking is because it's now looking at a federal statute, right, and implement TILA, right? And reading within the statute, that it covers something along the lines of overdraft fees in these instances, right? So this could absolutely get challenged. I mean, let's just be honest out there, right? It's possible that somebody may challenge this notice of proposed rulemaking. We saw a challenge to the Bureau recently when they changed their examination manual to read into UDAP a discrimination component, right? A disparate impact component in marketing and advertising. And it's obviously the Bureau has appealed that to the Fifth Circuit. But we are seeing, though, obviously increased and aggressive act doesn't mean it's going to get a challenge. But the point here is that I think that the way the answer is that it requires notice of proposed rulemaking because you're actually, interpreting and implementing a statute through a regulation, right? I think we can move on to the next question. And I know there's questions coming in. I mean, we'll answer as many as we can in the middle or at the end. But I wanted to let anybody know that if you have a question, do type it in. Jen?
Yeah, so this ties into, things that we've been saying before that, the CFPB has noted, and we've also noted in this discussion that most banks have done away with fees for, bounce checks or surprise depositor checks. And it seems as though a lot of banks or fintechs are getting rid of their overdraft fees. Do we think that's a trend that's going to continue, or do we think there are other fees that these banks and fintechs are going to get rid of going forward?
I'm not sure how many fees are left at this point.
It's a very good point.
I believe it was Armen who said, I mean, I think, if you look at the landscape in the fintech space, I mean, that's part of the value prop of the fintech is that these were very low fee products, that they weren't loaded up with all sorts of fees. I mean, obviously I really can only speak to my own institution, but you're really limited to like a late fee and maybe an NSF fee. And then an annual fee, right? Some products have annual fees, some don't. So yeah, I mean, that's clearly the regulatory environment today is very anti-fee. I think it is difficult. I think we're put in a tough spot in our industry because a handful of times in the presentation when you talk about the definition of a junk fee and you mention it being hidden. Well, our products, for the most part, are governed by TILA, by Reg Z. These are disclosure statutes. By its very nature, it's very difficult to call a late fee hidden when it's, prominently disclosed in the Schumer box for a credit card and it's on the credit card statement. It's very difficult to say, how is that then a junk fee if it's not hidden? But, it's an argument we continue to make and, seems to be falling on deaf ears for the most part, though, with the current administration. So, to answer your question, Jen, yeah, I think we're going to continue to see a cutback in fees. I just don't know which ones are left at this point.
Yeah, Brad, I think you're right. And Armen, I think you're right. I think, fintechs need more, deserve a lot of credit in terms of shaping the industry right now. I mean, on our bank side of things, we've removed fees to be competitive with what our fintechs are offering on the consumer side too. So I think the trend is certainly there and it's going to continue to, remove as many that still exist. And Brad, I think you're right. I mean, I'm not sure exactly which ones are still left at this point to target. So, but
I do think the election will matter, right? So we know that the Supreme Court ruled, I think it was 2020, and why we saw Kathy Kraninger leave so quickly after Biden took over. The Supreme Court said the director can't stay for 5 years. So we could see a shakeup this year at the CFPB. FTC, my understanding is traditionally people don't hold over very long, even though I think there's only 3 of 5 commissioners there now. But I think we could see a change in certainly tone. I would bet $100 that the new administration. I would bet an overdraft fee that the new administration does not use the term junk fee. I think this conversation can easily happen without the word junk fee. We could be talking about UDAP, we could be talking about TILA, we could be talking about overdraft. But the rhetoric is very good, and of course that rhetoric will be used extensively in this election season. So and by the way, as Juan and Jen pointed out, this is we're in our like silo of silos of fintech. It's obviously financial services and it's obviously all industries. And I think a lot of us don't love it when Ticketmaster throws out random fees when we're buying our ticket to whatever, or hotels. I'm in DC right now. I love the resort fees in this town. They're awesome. I get nothing out of them other than paying 35 more bucks. So this is a huge issue and people really care and it's polling really well. So it's gonna be a big part of the campaign. So it will heat up. But if there isn't a change in administration, if there's not one, I think there are more fees in the chopping block. What I would do is I would look at standards outside of Washington for what could be next. So like a good nonprofit standard to look at that actually I think the Biden's going to be kind of stealing from a little bit are the bank on standards for banks. It's a nonprofit that a lot of banks will offer an account that's bank on certified that has certain provisions and doesn't include a lot of fees. So shockingly, bank on standards say no overdraft, no NSF. So we've seen those, of course. They also call for no monthly fees, no fees for account activation, no fees for bill pay. So these aren't like the biggest fees, but they are around. So think about something in those nature. And then I would also, even beyond bank on in that genre, fees for incoming wires, replacing ATM and debit cards. We've seen in some institutions, things that you can just see how this could snowball. Investigating fraudulent activity, some charge for. You can see how there are some things out there. They're not the big names though, to Brad's point of what's left. So that's one area to look at, the bank on stand. I think the other, and Juan mentioned the states in California. He mentioned one law, which is a little like the FTC law, right? Like the California law is kind of, it's a bit of a process law that says, don't charge a bunch. Do your total cost. Don't have what they call drip fees, where you start adding a hotel fee and the other surcharge at the end. But there are other laws in California. Actually, California just passed also a small business protection law, which is less process like FTC and more substance, like what the CFPB is doing. And it basically says, hey, we don't want to see any redundant fees at all. So if you're charging an underwriting fee, fine. But we better not see a origination fee or a diligence fee also, because like that's the same thing. And it also calls out certain fees that small businesses get charged and says, we're just going to look at these really heavily. It names wire fees as an example. That's kind of why I mentioned incoming wires earlier as a potential area. It also mentions fees to place liens on your property if you're getting a loan that's on a lien. So kind of the states are going to show us a lot in addition to these nonprofit standards. And the last thing I'll say is besides look to the states and besides elections mattering and the junk fee rhetoric would be just size is going to keep mattering, right? Like a lot of these fees are for banks above 10 billion, not all, but a lot. And we've seen the administration kind of give a pass, this one at least, to smaller banks when they're out doing their public shaming thing they've been doing the past couple of years. We've seen them focus on the bigger guys above 10 billion. And we've seen that even in their own data, NSF and overdraft fees, they will proudly show are going down 20, 30, 40% for banks above 10, but banks below 10, they don't really talk about it, down 5%, 4%, 6%. So I think size is going to keep mattering, and the larger banks should expect more impact than the smaller ones.
Armen, I'm going to take a question here because it's an interesting question that you mentioned something about the state applicability to small businesses, right? And the question is, would the overdraft NSF fees apply to only consumer loans, or would this apply to commercial and small business loans as well? I think this is an excellent question. And it really depends on which fees that we're talking about. Are we talking federal or even within federal? And I'll explain in a second. The CFPB is a consumer bureau, right? It's to protect, it's consumer protection, right? Or TILA is a consumer statute, right? So for those purposes, that deals with consumer credit, right? So when we're talking about the overdraft, recent overdraft notice of proposed rules making, that's on consumer. But it's a little bit more nuanced than that, because when you're looking at its NSF fee, and in particular, when you're looking at, we said how the OCC and the FDIC had said that some NSF fees could constitute a violation of UDAP, right? Section 5 of the FTC. Section 5 of the FTC, in some instances, could apply to small businesses. We've seen actions, right, on unfair, deceptive practices that involve small businesses. So there's a possibility there. And then, as Armen just mentioned, you know, in some states, the state could come out and here and make it much broader to small business wire transfers or whatever it might be. So it isn't all consumer, but I know we tend to focus on the CFPB because that's the loudest, right? Regulator right now. So do keep that in mind. It could potentially also bleed into commercial and small business loans as well. Jen, let's go to the next question, see if we can get through some great ones that we have.
I mean, yeah, we have a lot to talk about. I guess just one thing I would want to follow up with what we're saying is, how do we think, if at all, that this will backfire on them and ends up hurting consumers? Like all of the measures that they're taking, do we think that it will end up hurting consumers?
Well, if I can jump to the credit card late fee, I'll say yes. I mean, this is the classic of, you know, some bad apples, now I'm blowing the phrase, right? Bad apples ruin for the whole bunch, because I think what you're going to ultimately see is if you can't target bad actors, if you can't target late payers with a late fee, you're going to see higher APRs, higher annual fees, and then probably, you know, to the extent that other fees are still allowable, you know, you'll probably see the pop-up of some new fees as well. I mean, that goes after, you know, whether they're, you know, different types of accounts. You know, let people imagination run wild, but, you know, especially after some of the big banks went over kind of that 29.99 threshold for APRs and credit cards last year as prime was going up, you know, that 29.99 sort of soft cap has been blown through. So I don't think there's much holding back institutions from continuing to raise APRs and raising AMF fees. I mean, AMF fees are probably the easiest things to raise, right? I mean, that doesn't require tech work from the businesses, from the companies, for the most part. They're already in place. So, you know, this revenue is going to get made up. It's going to then end up hitting everybody across the board, as opposed to just targeting those that didn't make their payments on time.
This is for the panel, just to follow up on that. So do you think all you're end up going to be doing is shifting the cost to the consumer to somewhere else, right? You won't be able to these fees, but we're just going to make the fees that we can charge more expensive, right, or high, right? To basically, you know, how are banks and going to make up this and the fintech partners going to make up this revenue loss? Is that where it's going to be?
That's certainly my belief. I mean, you know, if they get rid of Armen's resort fee at his hotel, then the nightly cost is going to go up, right? I mean, the total charge, all in charge for the room ain't going to change. It's just how they address it.
But I do think that is kind of the fundamental debate, right? Like the left would say, and that's what we want, actually. First, it's better for competition if we know every price up front. So there shouldn't be a hotel fee or anything like that. Late fees, though, present a much more interesting issue than a silly hotel resort fee, right? Late fees are way more interesting of a topic because, to Brad's point, you're trying to disincentivize activity that in the contract it says we don't want you to do. The left, of course, will say, well, then make it proportional and not punitive, of course, because they're worried about does that disproportionately impact people who can't pay? Are those people bad apples, or are they people who are have more challenges? And it, obviously it's all of it. Like you can't. I don't know the answer to that question. But I think that's going to be a debate. So in some respects, it's, in my opinion, a good thing to force fees to the front, but not all fees make sense to be in the front because they actually depend on the action of the customer. And I think that's how we can draw a bright line about what's a junk fee and what's not, in a way. If there's no reason for it to be in the back end, then why is it on the back end? Move it up. And then we can have real competition, and good banks can win and bad banks won't. And we'll get to open banking later and how that fits in. But not everything's a junk fee. Not everything fits that rubric. So it's the debate. The word junk fee may be being over broadly applied right now.
Those are some very good points. And I want to make sure that we address open banking, which you just referred to in your response, because I think it's a really big thing. Do we think, you know, using Juan's words before, that there's clearly a move by the CFPB and the White House to, you know, divorce or enable customers to have more flexibility to, you know, divorce from their banks or divorce their banks. Do we think that this pressure on the fees is really market pressure aside from the regulatory prohibitions? in order to, you know, promote that concept of open banking?
Brad or Chris, I can take a crack at it, but I just talked a lot.
No, please do. Yeah.
You know, Jen, I think there are two questions in there. I'm just not sure I'm fully following. I'm hearing one, do we think market forces were already kind of forcing fees to go down? And maybe to Brad's point and what I just said, forcing fees to be more front loaded. I think we kind of addressed that a little bit on this panel. I think so far. I think the other question in there, and if I'm misunderstanding, just jump in and correct me, is
I mean, maybe I'll
how
just say it
does
another way if you want. You know, they're using regulatory prohibitions. They're, you know, referring to UDAP, or they're going to Reg Z, they're modifying Reg E. But do we think that ultimately it's just to promote this concept of open banking, that customers
I
can more
see.
easily move along, you know, from one bank to another, which typically they haven't been able to do because it's been harder. You know, like, for example, this advisory opinion saying that you can't charge for a customer to get basic information to make it easier for them to get this information. Do you think that there's this agenda ultimately, in addition to, you know, the regulatory prohibitions that they're citing?
Yeah, it's interesting. It's almost like the prohibitions are suggesting there isn't competition among banks. Because if there were competition among banks, why wouldn't the market solve these problems of back-end fees and the fees that the CFP is going at? So if there actually was competition, theoretically, under any 101 econ book, we don't need to have this panel. But we are having this panel. And that's because obviously the market is not perfectly competitive among banks. But okay, I'll do the kudos thing for fintech again. But fintechs and new banks are trying to change that. One, see how we led the charge in overdraft. Two, we should give props to the marketplace lenders in the association, see how their lower prices drove down prices across the board for credit cards. And then credit cards started their own installment products to compete with what the marketplace lenders were doing, who are in AFC, and try to undercut themselves on cards before they were undercut by marketplace lenders. So this group, I think, has done a good job creating that competition. That should obviate this whole debate we're having. But there's also another reality, that's a term open banking, right? So 1033 of Dodd-Frank is supposed to allow for the data of customers to flow easily between a bank account, a depository bank, and another bank that wants to compete with that bank, either by getting that deposit account and all its data, or by making a loan using that data, or using that data in some other way that can be helpful to the customer. And what we have right now, until open banking gets finalized, is kind of a monopoly of data by the largest banks, which is funny because it's the banks on this call and in AFC that are the ones that use data well, but they're the ones with the least data to use well sometimes because it's hoarded by JPM and the big banks. So like, if we're going to get the competition the CFPB seeks, we can do junk fees all day, but much more impactful would be make the open banking rule actually work and allow the people on this call to, when they're asked for a loan for XYZ and they go into the bank account of that person, look at other things. Hey, I see that you have a terrible deposit account. I see you have a terrible loan as other thing. Why don't you let us, the fintech, give you a better loan, a better deposit account while we're in your system? And that's the whole debate in open banking, if you ask me. It all falls on to what extent CFPB overdoes customer privacy over underdoing its intent of a free market in banking.
There may be some concerns about how long the open banking will take, right? To pass. I mean, I thought about this as well. Why do the bifurcating approach? It seems like a little bit overkill to me. I think typically we want to see market forces and competition before regulation, right? If we can help it, we want the market to or the industry to regulate itself. But it might be because of that. I wanted to give Brad and Chris, you know, since we're just running up the time, and any last comments that you had on any of this before in our final minute or so?
Yeah, I'll just kind of jump on that one. I agree with you. I think why you're seeing the sort of convergence of both open banking and the regulation is this acknowledgement that it ain't going to happen overnight. Open banking ain't going to lead to just free competition overnight. So this is a way in the short term to do that. Obviously, you know, believers in the free market would rather see the market handle it itself, but this is clearly an attempt to do that. So I agree with that hypothesis one.
Yeah, I agree too. Juan, I think you said it in your presentation and in the two-prong approach, and I think that's exactly right. So.
Great. Well, we're we're actually 1 minute over. There's one question is whether the slides that we shared, we can access them. And Becky, I think I have provided those slides to Elizabeth. So I'm happy for you to share those slides with the membership, of course, as well as obviously the recording. And I'll turn it over back to you, Becky, now.
Thank you so much. Thank you so much to everyone here today. It was such a great conversation. As you saw, that was very active Q&A box. We don't, obviously everyone was hanging on to your every word. So thanks again to Juan and Jen and Winston and Strawn for sponsoring this, and Armen, Brad, and Chris, as always, thank you so much for your time and your expertise. And thanks to everyone for